say, okay, right now we're in kind of rally mode. Why is it rallying? Well, interest rates are going down. This started in kind of mid to late October. The Fed signaled that maybe they're done raising interest rates, and maybe they are. We'll talk more about that as we get closer to the December meeting. So, if interest rates go down, stocks go up. That's the narrative. Wall Street always has a narrative for you. Goldilocks, soft landing. There's no such thing as a soft landing, by the way. There are hard landings, there are crashes, and there are booms, but there's no such thing as a soft landing. If you're going down, you're going down.
In September, the Federal Reserve maintained its benchmark interest rate for the second time in 3 meetings, signaling a shift in its anti-inflation strategy, reflecting a more measured approach as inflationary pressures ease. This decision was accompanied by the Fed's hint at a solitary rate increase for the year and a projection of a continuous rise in the key rate until 2024, exceeding previous forecasts. As the Fed prepares to reduce its key interest rate, the initial pace is expected to be gradual, ruling out a swift return to ultra-low rates. The year-over-year rate of price increases barely surpassed the Federal Reserve's target, standing at 3.2% in October, according to the Bureau of Labor Statistics. Investors interpreted this as a sign of an end to monetary tightening, drastically reducing the odds of a rate hike at the Fed's meeting. However, despite this cooling, unemployment rates remained near historic lows in October, and economic growth recorded its fastest rate since late 2021 in the third quarter. Yet public sentiment remains cautious as inflation expectations rose to 4.2% in October from the previous month's 3.2%. Concurrently, Jim Rickards attributes the current market rally's momentum to declining interest rates since late October. This shift was prompted by the Federal Reserve's indication of a potential halt in rate hikes. Contrary to prevailing narratives like Goldilocks scenarios or soft landings, Jim suggests these ideals diverge from harsh economic realities. He contends that economic downturns tend to be abrupt rather than gentle, challenging these optimistic narratives. Anticipating a potential downturn in the stock market, Jim foresees forthcoming data, likely by year's end or early next year, strongly indicating an economic downturn, potentially leading to a substantial contraction in the stock market. Despite warning signs, prevailing sentiment on Wall Street continues to align with the Goldilocks narrative, highlighting the disconnect between popular belief and economic realities. While the market hasn't peaked yet, Jim forewarns a possible significant downturn, possibly ranging from 30% to 50%, reminiscent of historical recessions' market crashes. We will present clips from Jim Rickards' interview with Paradigm Press. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
So that's why stocks are rallying right now, because interest rates are coming down. But what people don't stop to ask is, okay, interesting, why are interest rates coming down? Could it be we're in a recession? Could it be we're seeing disinflation, maybe even deflation? Could it be industrial production is down, which it was? That was reported the other day. Initial claims are up. That was reported the other day. Unemployment ticked up a little bit, not huge, but in the last employment report at the beginning of November. This is in addition to the more technical signs. I don't want to get too far in the weeds in terms of inverted yield curves and negative swap spreads and a lot else. Those are long-term or long-range indicators of recession. We've been talking about those for a year. They're very powerful indicators, but they don't tell you the exact timing. But the other items I mentioned, things like industrial production and so forth, are much more real time, and they're all turning negative. So I would expect the stock market to turn around and kind of go down significantly, between now and the end of the year, early next year, certainly, because by then the data will be undeniable. Right now, again, the Wall Street Goldilocks soft landing scenario prevails. It doesn't mean it's right. It just means that that's what people believe. But Wall Street, again, they're just trying to sell you stocks. They'll sell you stocks right up until the day it crashes. I'm actually writing one of our newsletters. I'm writing it today, and I went back and looked at the recessions in 1974 and 1981. And the Dow Jones in 1974 recession, the Dow Jones fell 45%. In today's level, that would be the equivalent of 15,000 Dow points, slightly more. So wow. Imagine the Dow Jones down 15,000 points. That's a 45% decline from today's level, and that's what happened in 1974. It's not ancient history. What caused it? Well, it was the a war in the Middle East and Arab oil embargo and higher oil prices. Does it sound familiar? I mean, that's kind of what we're going through right now. We're going back to 2021 with the supply shock. And then in 1982, 81, 82, that recession, the NASDAQ fell 38%. So, peak to trough. So that's what a real recession looks like. And that's what a stock market crash looks like. And so we could be heading for something like that. But, it peaks when it peaks. But by the way, it peaked 2 years ago. So we're not even at the peak. But yeah, it could go down 30, 40%, maybe 50% from here.
The U.S. stock market began the week with a decline, led by a sell-off in technology shares. The Dow Jones Industrial Average experienced a decrease of 144 points, representing a 0.4% drop, while the S&P 500 and NASDAQ Composite faced more significant decreases of 0.9% and 1.1%, respectively. This reversal contrasts sharply with the recent upward trajectory in these indices, with the S&P 500 reaching its highest closing point since March 2022 last Friday, and the Dow achieving its first 5-week winning streak since 2021. Jim's perspective sheds light on a longer-term view of the market, emphasizing that despite recent intermittent rallies, major indices like the S&P 500, Dow Jones Industrial Average, and NASDAQ 100 have been on a consistent downward path for over 2 years, dating back to late 2021 and early 2022. While acknowledging the profitability potential within these intermittent rallies, Jim urges caution against excessive enthusiasm tied to these short-lived market fluctuations. He underscores the inherent volatility within the market, characterized by frequent fluctuations, emphasizing that despite these short-term peaks, the overarching trend remains firmly on a downward trajectory. This perspective serves as a reminder of the market's inherent unpredictability and the importance of considering long-term trends amidst short-term market excitement. Let's get back to the interview.
The S&P 500, the Dow Jones Industrial Average, and the NASDAQ 100 all peaked in late 21 and January 2022. Look at a 3-year chart. Stop looking at a 3-day chart. I don't mean you, I mean just people in general. Stop looking at 3-day charts. Look at a 3-year chart. They all peaked. NASDAQ peaked in November 2021, and Dow Jones and S&P peaked in January, like the first week of January 2022. Those indices are down significantly from where they were almost 2 years ago or over 2 years ago. So you can talk about the bull market all you want. They're down over the last 2 years, period. Now, has there been a rally lately? Yeah, and there have been 4 or 5 along the way. And I'm not saying you can't make money, but I'm saying that in this volatility, up and down, the trend is down. So let's not get too excited about the stock market because the trend is down, as I described. Just look at a 3-year chart. You'll see exactly what I'm talking about. Now, where do we go from here? Oh, stock markets are bubbly in the face of something horrible. Where we've seen that before. I mean, the stock market during the cycle around the 2007, 2008 financial crisis. Remember, that crisis started in the spring of 2007. It kind of reached a fever pitch in August 2007. That was when Jim Cramer had that famous meltdown with Aaron Burnett on CNBC. They know nothing, et cetera. But the stock market actually peaked in October 2007. So there we are 6 months after HSBC warned about rising defaults in mortgages, 2 months after the Fed almost caused a meltdown. Jim Cramer called them out in August 2007. But the stock market peaked in October 2007. So stock markets go their own way. They're supposed to be leading indicators. They're really not. So first of all, the stock market is not peaking. The peak was 2 years ago. Right. And the peak is exactly when I said kind of November 15, 2021. So that's more than 2 years ago. And it still has not regained that peak. So that's the reality. Now, you're right, Matt, there's some rallies, but there's some big dips along the way if you're looking at it. Okay, right now we're in kind of rally mode. Why is it rallying? Well, interest rates are going down.
Economists predict the U.S. Federal Reserve will keep interest rates unchanged until at least July, focusing initially on adjusting the real interest rate rather than implementing stimulus measures. This forecast contrasts with Chair Jerome Powell's recent statement affirming that policymakers are prepared to tighten policy further if it becomes appropriate. How might the Federal Reserve's approach to interest rates and inflation impact the market, especially given Jim Rickards' contrasting view on the current rally? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.